Welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, rate strategist, and I'm joined today by our global market specialists, Giles Gale and Brian Daingerfield. Before getting into today's discussion, I just wanted to remind you all to hit subscribe, and if you like today's episode, then don't forget to hit the like button. So we've had some fairly big moves in fixed income markets this week. So Giles, I'll go to you first of all, because I think 10-year bonds are probably around 15 basis points higher than where we started the week, or certainly since when we were chatting last week on the podcast. What do you attribute to the drivers to those moves?
So, I mean, a number of things, right? I think that fundamentally, as we've been repeating on this podcast, I think the valuations were just wrong, and the markets are starting to catch up. We have been highlighting that the inflation risks are clearly, in our opinion, they have been on the upside, and we've been repeating that central banks are going to have to do more. And so, I mean, to answer your question in the simplest way, it was the Fed last week, and the message from there, and so that sort of sent the market scrambling to price more in for the Fed. And so clearly every meeting now for the Fed is going to be live. We think that the risks are that we could see one or more 50 basis point rate rises as well over the course of the year. And we think that the markets need to push where they think policy rates are going to get to up above 3%. I mean, that's not that they'll get there straight away, but I mean, they should be seriously considering that. They're still not there, but they're moving in the right direction. So, I mean, to a certain extent, that was the catalyst for the move. It was US led in that sense. But I think that the nearing of the end of quantitative easing in Europe is also a very important and significant theme. This is something that now people feel that they can, I think, express. And I think to a certain extent, people are realizing that there's going to be fiscal slippage, there's going to be more bonds as part of that. There's also been a certain amount of pent-up demand to come to the market by funders more generally, so not just sovereigns, but also agencies and corporates, because obviously over the early stages of the sort of very volatile market that we were sent into because of the invasion of Ukraine by Russia, it has been more difficult for people to access the market. And so as things have quietened down and we've sort of, the markets more broadly have regained their composure, we see the supply coming back on tap. And so people are thinking more about that. So it's a whole bunch of things all coming together at the same time. I will just end by saying that I think that we probably had a decent amount of the correction that we needed to have in the short term, but I don't think that this is all done now.
Well, that leads me nicely on to my next question, because listeners last week, or in any case, avid listeners, and before you make the joke, I'm sure there are some, will know that we've been targeting 0.5% in 10-year bond yields for a while now. And we had the momentous occasion this week of actually reaching that target. You promised listeners last week that you would update us on that view this week. So although you think a lot of that kind of momentum in the short term has played out, you obviously think this has further to go in over the longer term. So how much further can those rates really rise?
Right. I mean, of course, I have a number in mind, and I did promise that we would update listeners, and I haven't had the time, unfortunately, to write the full explanation of why I think we're going to go to where we're going. I think higher is right, okay, and I think actually meaningfully higher is right. Now, another thing that we've said frequently on this podcast, and I will repeat now, is that I think that the world is in a sense being remade as a result of this war and the pandemic, and we absolutely should be considering quite dramatically different outcomes in markets as well as macro variables. We can see what's going on in inflation, of course, but I think we are transitioning to quite a different world, which means that I think that to take an incrementalist approach here and just say rates should be plus or minus a few tens of basis points compared to where we were before the pandemic is wrong. And I don't see why we shouldn't be talking about 100 basis points potentially, or 200 basis points. That's not to say that I think that that's necessarily what we should be targeting for this year, but I do think that this is a serious discussion that we should be having.
Well, we worked out yesterday that I'd never seen 1% 10-year bond yields in my career so far. So that will be an exciting moment if we do get there. All right then, Giles, I like that you've kind of dangled the fact that we might come back with a more precise number when you've written up next week for listeners. So stay tuned. With that then, I'll move over to you, Brian. I mean, Giles already went through some of the kind of Fed-led reasons for, or US-led at least, reasons for the sell-off this week. Is there more to it than just the Fed and what Giles kind of went through just then?
Well, I think between what Giles had said and what John Navruzzi said on this podcast last week, thinking that, excuse me, the next evolution of Fed pricing is likely to be towards greater risk of 50 basis point moves in the near term, with the Fed dot plot last week showing 7 rate hikes over 7 remaining meetings, including March. It was clear that the median member had a baseline of 1 hike per meeting for the remainder of the year. So where do you go from there naturally if the market is pricing ahead of the Fed, more hawkish than the Fed, and has been generally right in doing that? The next logical evolution would be to price towards additional risk of 50 basis points in the near term. And that's exactly what we've gotten. And now, certainly this is as much an aftermath of the March FOMC meeting as it is anything. But we did also have comments from Fed Chair Powell on Monday at the NABE, where he laid out perhaps a personal view rather than just speaking for the committee, which was quite hawkish, where he was very clear that the Fed would consider 50 basis point moves if it deemed it necessary. One specific quote that was a big takeaway from certainly for me, and I think for the market, was he was asked whether the decision on balance sheet rundown, which looks very likely to come at the May meeting, would that preclude the Fed from acting 50 basis points at the May meeting? And he said nothing would necessarily preclude acting 50 basis points if they deemed it necessary. And so there is no roadblock. There's no technical reason why they don't think they could go 50 at that meeting. And so the market pricing has adjusted in that direction. And I think Powell's comments, while not necessarily new, I think really reinforced that move. The other thing to look at is that oil prices have moved back higher. And so break evens have also moved up a little bit. Over the last 3 weeks, the oil had fallen from its dramatic heights as the market priced out the risk of an EU oil embargo ban from Russia. Now some of that risk has come back in a little bit. There's been some tensions around Saudi Arabia, specifically with Yemen, that's also contributed. But that, oil prices, WTI front future is back towards $115 a barrel from as low as $100 a barrel just a week ago. And so that's probably also contributing here, is that you have oil prices moving back up a bit, break evens are a little bit higher. And so you can add that in to the Fed as a possible driver of these wider moves.
And so thinking about the, increasing, I guess, possibility of 50 basis point hikes at a or some of the coming meetings, where does that leave your, I guess, Fed funds forecast? Do you think that this is, we are likely to get at least one, if not more, 50 basis point hikes over the next 6 meetings this year? Or is our base case still for, in line with the dots that was 25 basis points per meeting for the rest of the year?
So I should say our firm view, our economist's view, is still that we end up with 7 25 basis point rate hikes as a baseline. But certainly that risk feels more palpable today, even than it did last week. We think the inflation numbers are probably not going to come down anytime soon. Powell echoed that same sentiment, basically saying, look, we don't think we're going to get an improvement in the inflation forecast, in the inflation picture, backdrop, I should say, in the near term. So certainly, if inflation is doing the driving right now, and the Fed is increasingly worried about entrenched upside risks to inflation and rising inflation expectations, both in near term and long term, certainly that risk feels like it's materializing much more palpably, and the market is certainly moving in that direction. And now a core view of the US rates team, John Nevruzzi talked about it last week, August Fed funds contract short, that position was partially because of the expectation that 50 basis point rate hikes were likely going to rise over the course of the year. And so we certainly keep to that view. Whether or not they deliver a 50 basis point rate hike is probably going to depend critically on the inflation numbers. If those numbers stay high, that risk is probably going to remain high. And so to echo what Giles said, we're in just a different environment. The pandemic and Russia's invasion of Ukraine have changed the game. They've changed the environment for rates markets. And that certainly plays over to the US and for the Fed as well.
So when thinking about 50 basis points, then whether we get, one or more than one over the next couple of meetings, is that just about more front loading of tightening? Or do you think that that's, markets will need to raise where they see the terminal rate? Does that just bring forward a hike that we might have had next year, for example? Or is this genuinely more tightening coming faster?
Well, if you look at where the market is, the market clearly thinks we're front loading the rate hikes because we actually have rate cuts priced in, I believe, into 2023 and 2024. So the market clearly sees this as pulling forward rate hikes into 2022 and 23, and then having to pay that back later by increasing the odds that the Fed actually starts cutting rates later. And one thing that was mentioned on the podcast earlier, this is all really a question of where does the cycle end? Where is the terminal rate? Does the cycle end below where the Fed thinks the neutral long run rate is, or does it extend higher? We think it can extend higher. And if the economy continues to stay strong, the market's probably going to have to reassess, how far can we go before we start pricing in rate cuts? And so I still think that you can price in more, and that more hikes overall in the cycle can be priced. But that might be a 2022, 2023 story, and the market may still feel very comfortable thinking that if we're having multiple 50s as a baseline in the US, for example, then certainly you could see that priced as cuts later down the road. Even if the market's ultimately wrong in that assessment, I think that kind of market mentality can continue. This sort of policy error type front loading type pricing, I think, can continue. Even if we think it's not necessarily the right move, I think the market can continue to run, and they're not going to be proven wrong anytime soon on that. The question over whether or not the Fed is making a mistake over tightening too fast, those questions are going to remain very relevant well throughout the year. And so do we think that move might be wrong? Perhaps it is, but fading that at this point is something that feels really difficult to do with confidence.
Yeah, it certainly feels like a theme that we're going to be returning to probably frequently on this Bondcast. All right, thank you very much, Brian. So I suppose we should switch over to the UK then, where the focus this week has been much more about the fiscal side of things than the monetary side of things. So with that, I'll hand over to you, Giles.
To you. I mean, we started off with the CPI, which I don't know if you want to talk about really, because it was more or less as expected, and I just say very high. But obviously the main business of the day was this gilt remit around the spring statement from the Chancellor. And so perhaps you'd like to just give us your view of that. I know we got less gilts than you were expecting.
Yeah, of course. I guess the headline takeaways for us is that the kind of borrowing numbers were net borrowing is in line with what we were expecting, but the actual gilt issuance number was lower by around 30 billion, and that was driven by the fact that there was a bigger undershoot in borrowing last year than we had penciled in. That accounted for most of the difference, actually. And then the second part was that there was slightly more treasury bill issuance that the DMO planned to do in the year ahead than we had penciled in. So to put some numbers on that, we'd initially thought the gilt issuance for the year ahead would come in around 158. It's actually going to be about 125 billion. And for gilts, that represents a step down in issuance, like I say, bigger than we were expecting, but gilt issuance last year was about 195 billion. So a sizable step down.
Indeed. So yeah, I mean, famously supply obsessed market, the gilt market. On the linker side, very quickly, how did the allocation to linkers fit with what you were thinking, and what have they said about that?
Yeah, so I guess the composition was broadly in line. Well, on the conventional side, broadly in line with what we're expecting. We got, like I said, slightly more bills, slightly more shorts, and most of that was kind of to the detriment of mediums. Probably bigger than expected, to be fair, cuts in medium-term issuance. On the linker side, they totaled or will total around 15% of issuance next year, which was roughly in line with our expectations. But I guess the more important story when it comes to linkers is that for the last couple of years, the DMO has been aiming to cut year on year its proportion of linkers as a proportion of the total issuance. But actually this year in the DMO's report, they said that they're now happy with, I guess, the proportion of linkers as of their total issuance, and they won't be looking to cut that number year on year going forward. So it's around, it'll be 14.9 in this spring statement, and I imagine that they would look to keep that roughly stable for the next couple of years.
Yeah, so I mean, I suppose maybe that would surprise some people, just because obviously with high inflation, there might have been more upward pressure on the total stock of linkers within that debt portfolio, but apparently not. So I guess the big question then is how this leaves us strategically. I mean, is this bullish for gilts and negative for linkers, or what is it? No.
Well, I guess the very near term is that it's supportive for gilts. That number, that kind of gross issuance number, is lower than markets were expecting. There was a big range of estimates, but I think we were fairly close to the kind of middle of that range. And so that is, lower than I think consensus would have sat at. So the very near-term reaction is that this is supportive for gilts. But going back to everything that you and Brian have been saying about this being a kind of different world than pre-pandemic, we've got this kind of global inflation shock. We think that gilts should fully participate in this globally rising rate environment. So we still have a 10-year gilt target of 185, and I don't think today should derail that significantly, largely because although it is less gilts than we were expecting as a kind of headline number, if you look at supply to the market, or supply that the market is left to absorb once you take away Bank of England purchases, the number of gilts, or the amount of gilts left for the market this year will be still significantly bigger than it was last year, because we have that changing dynamic of Bank of England purchases. We haven't assumed or rather sales this year. We haven't assumed a huge amount of active selling from the Bank of England. I think we might have discussed it last week, but we've just penciled in around 10 billion of active selling this year, which probably occurs in the second half of the year. And there's a 9 billion kind of natural runoff of the portfolio that they won't be reinvesting. But net, gilt supply net of Bank of England purchases will be positive this year and much bigger than it was last year. I think the change versus last year is roughly around 80 billion sterling, and that is the biggest kind of year-on-year change that we've seen since 2017. So although the kind of very near-term supply announcement today is supportive for gilts, I don't think it detracts from the kind of bearish pressures overall that this changing supply picture offers.
So more bonds, it's a global story really, isn't it? So I'm very excited now, because having ended this way, I sort of feel like I'm the one that should be telling you to hit the like button, and we look forward to talking to you next week. But Imogen, I think you better do that.
Oh, now could have been your chance. Now you're throwing me off. I've forgotten what I was saying. Okay, great. Thank you, everyone. A reminder to our listeners that if they like today's episode, they should hit the like button, and don't forget to subscribe so you can get the latest episodes as soon as they're available.